Historical cost principle. Now what is this? Now a business, in order to run, acquires various assets. Okay? Let's say there are various years which are there. Year 1, year 2, year 3, year 4. Okay? Please bear with me as I am drawing these lines from hand, so they may not be the perfect one which we would ideally want. But nevertheless, what is important is the concept understanding. Now, let's say for example, you bought an asset. Let's call this as plant and machinery. In year 1 at, let's say, 10,000. Okay. Now this asset which was acquired at 10,000 is going to be depreciated, okay, over the period of years. Let's say, for the sake of simplicity, I'm assuming that depreciation that is charged is 1,000 per year. This number can actually be different, okay. Depreciation, as I had indicated earlier also, is basically the reduction in the value of the asset arising due to passage of time. So this plant and machinery, as it is going to be used from year 1 to year 2, from year to year 3, year 3 to year 4, we normally provide for depreciation to account for the fact that, there is some reduction in the value of the asset. So let's say the depreciation in year 1 is 1,000. Okay, from the value of the plant and machinery, I reduce 1,000 and I get 9,000 as the closing value. Closing value for year 1. This closing value basically becomes my opening value for the next year. Again, I provide depreciation. The value comes down to 8,000. This closing value again becomes the opening value, and so on. Again, I charge a depreciation of 1,000, 7,000. I'm not getting into year 4 right now. Now for accounting purposes, what we do is we continue to recognize the asset based on the historical cost of the asset, which is nothing but the price paid to acquire the asset. Price, or let's call it as acquisition price, less the depreciation. Okay. Now it might just be that the market value of this asset, market value means what? If suppose today I go and sell out this machinery, okay, let's say at the end of year 1 the value might be 8,000 only, right? In year 2 I have a book value of 8,000, whereas the market value may actually be 7,500. In year 3 the actual market value may be 7,200. It can be less, it can be more. So let's say for example in these 2 years the book value is more than the market value. But we do not account for these market values in the books of accounts. These market values are not accounted for in the books of accounts. In the books of account, what continues is the historical cost. So historical cost implies that you carry on the asset based on the price paid to acquire this asset, less any depreciation which might be there in case of depreciable assets. We completely ignore the market value. And what is the reason for this? The reason for this is, let's say for example, suppose we start recognizing on market value. Now how do we estimate what is the market value of this asset? Either we go to a valuer to find it out, okay, or the auditor may himself make a judgment. So then what will happen is that there will always be a question whether this is 8,000 or whether this is 9,000, whether this is 7,500 or this is 7,000. So to avoid this objectivity, personal bias of a person, the historical cost principle basically says that an asset has to be recorded in the books of accounts based on the acquisition price, and we do not make adjustments towards the market value of the asset. This is what historical cost principle is all about.